Silver has been in the headlines, but have you ever think why does its price fluctuate so much? Let's explain this. Today, we dive into the fascinating world of silver. We'll explore its origins, usage, and pricing mechanisms. If you trade or simply want to understand silver's role in our economy, you're in the right place. Let's break silver down into three main parts: supply, demand, and pricing mechanics. I'll provide reliable sources for detailed information about silver which you can reference. Links are in the description. First, let's start with where silver comes from. Surprisingly, silver doesn't come solely from silver mines. Around 70 to 80% of silver mined is a byproduct of extracting copper, lead, and zinc. This means silver supply is closely tied to the economics of these other metals. Miners don't increase silver production solely based on its rising prices. Although primary silver mines exist, they are relatively few. Additionally, recycled silver does contribute to supply, but it can't return to the market quickly due to recycling and refining limitations. This connection to other metal markets means that silver supply is relatively inelastic. Rapid price increases don't instantly equate to a surge in new supply. Now the question is, which country produces the maximum silver across the globe? The country with the most silver mining production and therefore effectively the most silver mined in the world is Mexico. Mexico has been the largest silver producing country globally, producing more silver than any other nation in recent years. Mexico is the number one silver producer in the world with around 6,300 metric tons of silver mined in 2024, almost double the output of the second largest producer. Following Mexico, the next biggest silver producers are China and Peru, though Mexico remains at the top by a wide margin. So, Mexico has the maximum silver mines production in the world right now. This makes it the most important country when talking about global silver mining capacity. Now, let's move on to the demand side. Silver demand can be categorized into four main areas: industrial use, jewelry, investment, and also smaller segment for photography. Currently, industrial demand is a significant factor. Industries like solar energy and electronics are leading consumers. The solar sector, for instance, relies heavily on silver for photovoltaic cells. As solar and electric vehicle usage increases, industrial demand has grown more important than ever. With increasing industrial demand, silver transitions from being seen as a mere precious metal to becoming an industrial commodity. This change makes its prices highly sensitive to technological and energy trends. Now, what about investment demand? This comes from various sources like retail buyers purchasing coins, large investors opting for ETFs, and traders involved in futures. A notable player is the iShares Silver Trust, SLV, which requires physical silver to back its shares. When investors buy shares in SLV, the fund must acquire physical silver, affecting the market supply. Conversely, when shares are redeemed, silver is released back into the market. You can think of SLV as a giant vault. Instead of carrying around heavy bars, people buy shares. When new shares are created, physical silver goes into the vault, impacting overall availability. Next, let's talk pricing mechanics. The spot price refers to the current market price for silver, often quoted per troy ounce. Futures contracts on exchanges like COMEX allow traders to lock in prices for future delivery. Producers and speculators use these contracts to hedge bets on price movements, introducing volatility. Physical silver coins and bars trade at a premium above the spot price. This premium fluctuates based on minting, distribution, and retail demand. When the market tightens, this premium can rise sharply. Moreover, indicators such as inventory levels and leasing rates signal market tightness, as falling inventories can lead to quick price shifts. Now, what drives price movements? Look at the interplay of supply, demand, and macroeconomic factors. The strength of the US dollar plays a critical role since silver is dollar denominated. When the dollar weakens, silver prices typically rise. Interest rates also impact prices. Lower rates make silver more appealing. Geopolitical tensions can push investors towards precious metals as a safe haven. Lastly, speculative trading can cause short-term volatility. As we wrap up, here are some practical tips. Silver can be more volatile than gold due to its smaller, less liquid market. If you buy physical silver, be aware of potential premiums, as well as storage and insurance costs. Using ETFs can help you avoid storage issues, but be mindful of fees. Futures trading is intricate and carries high risks, not suitable for most retail investors. Always verify your information. Check reliable sources like the USGS, Silver Institute, and ETF documents when making financial decisions. Now you understand how silver supply, demand, and pricing interact. If you found this information helpful, hit like and don't forget subscribe for continuous updates and stay ahead.